This is the first in a dedicated series of discussions on SoFi's business. Today, our first guest is Christopher Hoeger, a chemical engineer and Seeking Alpha contributor. Christopher has written many articles on SoFi and knows a whole lot about SoFi's lending business, which, as of right now, is its profit engine. Lending is our main topic for today, but if you find this discussion helpful, please follow Christopher on Twitter as he provides a ton of useful info on SoFi's business. I hope you guys enjoy.
Could you just introduce yourself, how you came to find out about SoFi?
I guess how I found out about SoFi is I was actually at work. So I work in a pretty small office. At the time, we still are pretty much a startup culture. At that time, we were a startup. We hadn't even been acquired yet. But I was sitting there and I was complaining to my coworkers about having to go into my Chase Bank branch for some stupid reason or the other that they couldn't do over the phone or over the internet. And they're like, oh, I was like, there should be a solution where I never have to enter a branch ever again. And they're like, have you tried, my one coworker was like, hey, you should try this thing called SoFi. Like that's kind
Wow.
of their deal. And then my other coworker who was like sitting on the other one was like, yeah, I've got SoFi. It's awesome. And so anyway, so we're basically exactly SoFi's target audience. So we're a bunch of millennials, um, make like the salary that SoFi is like targeting, and we've most of us kind of have like families and stuff, and I think everybody, like 9 out of 10 of my coworkers on average, like use SoFi as our primary bank
Wow.
account, right? It's
That's
it's a great, anyway. So I got into, and I like had the banking experience. Like I created an account and I was like, oh, this is super easy and user friendly, and I never have to go to a like branch again, which I never want to have to do. And I don't work with cash, so it wasn't a big deal, right? And so anyway, so then I was like, oh well, maybe this will be a good investment, and so I started looking into it, and that's anyway. So
yeah.
that's who I am. And most of the reason, I guess, the reason that I like to write articles, it's more like you don't know if you really have learned something until you can teach it to somebody else, right? Like it's a way for me to kind of crystallize my thoughts on the investments that I make
Hmm.
and kind of put my due diligence into like a narrative. And then if I'm doing that anyway, I might as well like write something about it and then let other people, if they're interested, like read it.
Correct me if I'm wrong, but I think you have 8 articles on Seeking Alpha about SoFi now.
I think that's probably about right. Yeah. And it's over the course of over a year that I've written those. So
Wow. Wow. So you've been and that's weird because I usually, when people say that they learned about SoFi, it's either through advertisements or like referrals, but I never hear like the actual word of mouth story, which I feel like that's what SoFi is going to be in the end game, is like, yeah, just get SoFi. Stop dealing with this bullshit.
yeah, it was the guy that I report directly to, like the guy who he's our project manager, and we were just chatting because we had, desks next to each
Wow.
other, and he was like, "Yeah, you should try this." So, and then we've
Well,
gotten at least three other guys who sit around us are now also in SoFi and have SoFi stock. So there you go.
did you get the referrals?
I got one of them.
There you go. um, okay, so now that you explain like that, how you came to learn SoFi, and also you're starting to invest in SoFi. What made you invest in SoFi? Like from a high level view, like what is SoFi and why is it an appealing investment?
I get very high level. So SoFi is a one-stop shop for all of your financial needs, as Anthony Noto loves to say, right? So the point is that you can go in there, you can have your checking account, you can have your savings account, you can use it to buy and trade stocks, you can use it to track all of your different financials, you can have a mortgage and other things on it, right? You can refinance student loans and take out personal loans. And so the point is, eventually they want to be able to be the only place that you need to go to be able to do everything that you need to do for your financial welfare, right? And they've got things like free financial planners if you're a member, and other things that are
Oh
really
yeah.
helpful. Um, and so so I opened the checking account, and so I did it in January 2020 is when I became a member, and that's when they really started to roll out all these new products, was like right after that. So they released like invest and credit card and relay like in the first year that I was a member. And so I was like the use case for like cross-selling, because I was like, oh, that sounds cool. Yeah, I'll use them as my 2% cash back everything credit card, right? And so I just signed up. And then I was like, and then I've been investing in like individual stocks since I was in college. But I was like, oh yeah, I'll just use their trading platform because I'm here, right? And they're going to give me a free stock, so I might as well. And so like I started using all their products, and then I was like, this is just so much more user friendly than any other
Mm.
bank that I've ever used. So in the past, I'd used kind of more the legacy banks. And so I started looking into it and doing due diligence and found out about Galileo and kind of everything else that goes along with the stock, um, and decided to invest. And then I guess so that's like the high level from that's like SoFi's pitch to you of what they are. From an investing standpoint, I guess a description of the company is kind of they're broken up into three segments: the lending segment, which provides most of the revenue and profits right now; the financial services segment, which is like the credit cards and the invest product, and the relay product, which is kind of a dashboard to see all of your finances from different accounts and stuff. Um, and all of those products are financial services. And then the technology segment, which is Galileo and Technisys, which the idea behind that is that they don't just want to end the consumer facing product, they want to own the back end too. So they want to have they want to be vertically integrated and own all the financial stack that they build all of their individual products on. And then they want to sell that to other companies who also want to create solutions for create a new financial institution to have solutions for other people. So from an
And
investor pitch, like the reason that I like it is twofold. I like it because it's growing a lot. It's small, and I think like because I enjoy it as a product, and I think anybody else who uses it ends up. It's really sticky. At least it was for me,
mm,
and it is for all my coworkers, right? And we're the exact cohort they're looking for. So it seems like they're doing something right. Um, and so from a consumer facing product, I like that. Then I like the vertical integration bit. So I like the fact that like since they own the technology stack, it allows them to iterate and also do like R&D and testing on us, the members, right? So they can create things much faster, for their own clients, but then they can turn around. So that takes a lot of money, and it takes a lot of time, and it takes a lot of effort to build that R&D and to build those APIs and to build the back end of everything that you have to do to, launch a product on a website, right? For a bank. But then all of that effort that went into that it saves them money because they don't have to buy that from somebody else. But then they can turn around and do the exact same thing that Amazon did and sell that to everybody else, right? So Amazon, they this is the AWS of fintech pitch, um, that everybody gets really excited about, which for good reason. Um, but the idea is AWS is Amazon built the infrastructure for what they needed. And so they needed a ton of different servers for all of their, for hosting all of their websites. They needed an infrastructure where they could physically store stuff. They needed all these digital services, and they came up with this stuff and poured all of this money into R&D to develop all these things so that their system worked flawlessly. And then they're like, we developed all these systems. We have a little bit of extra storage. Why don't we lease that out? And we have this, tracking system for all these things. Why don't we lease that out? And so they started to build Amazon Web Services because they were doing it anyway. And so they're like, if we develop this and we're pouring money into this, we might as well make it a product. And I think SoFi is doing the same thing with Galileo and Technisys. They need their own ledgers, they need the back end, they need the cores to run their credit card and the invest and everything else. And so, and they already have a large clientele of people who are buying stuff through either Technisys or who are using either Technisys or Galileo services. And then similar to like how when they got me, like I was just using it as a checking account because it was convenient, but then I, signed up for the credit card and I signed up for Invest because it was there. And similarly, I think, these businesses, these other fintechs like Chime and Robinhood and Revolut and everybody else, like they're using Galileo. And then when SoFi says, hey, by the way, we can do lending as a service, and hey, by the way, you can now offer credit cards, and hey, by the way, you can now do this but buy now, pay later business. Like if you're Chime, why wouldn't you? Right?
mm.
And so I think, anyway,
And
that's
it's a
the
pay as you
big
go model
picture
too, so
investor pitch.
it's
Yeah,
easy
that's
to
the thing,
like.
is it's super scalable.
Mm, so like when we were talking about high level, I like how SoFi can cross sell your products like no other bank can. Like a bank doesn't cross sell well at all, in my opinion, anyways. Like, uh, whenever a mortgage comes, you might go to your bank, but they don't do a good job of telling you like what like the next step is. They don't give you like smart insights based on like your past data that they've probably gathered up around you. Like, do you think that that cross-selling model is going to like what do you think about that, like how it used to be and how it SoFi is taking that advantage?
So I think I think it's just the way that all their data is structured, right? Banks have so much data, but I don't think that anybody in the bank can even like access or look at that data, right? Like uh, it's so siloed and so hard to like
What do you mean by
access.
siloed?
So like um, so for instance, it's like this is a big deal that Noto talks about. He says a bank should never ask you for your information more than once, right? Like if you're a customer, I should know your name and your birth date and your social security number, right? Because I had to open a bank account for you. So why should I have to ask for those things again when you apply for a credit card or when you apply for a mortgage and the reason why you do that as a bank is because each of those individual products is in their own silo, their own tech stack, their own core. Um, and so whereas at SoFi, right, they have access to all that. So when I signed up for a credit card, I didn't actually have to do that, and they already knew my FICO score, and they already knew everything else. Like it literally was like 3 clicks of a button to get a credit card. Um, and so I guess that's kind of they have access to the data, and especially through Relay. So this is something a way that they monetize Relay. So Relay is kind of like Mint. Lots of people kind of know. So it's a
It's
financial
like
aggregator. So
budgeting
you put
software.
in, yeah, a budgeting software, and you can put in your different accounts with different people, and it says, oh, this is your total net worth, and this is how much you owe on your mortgage, and this is, like how much you have in investment accounts, and how much you own credit cards and whatnot. Um, but that's a ton of data that now SoFi has access to, and they're using that. So um, if they see that you've got a bunch of credit cards and you're just paying the minimum balance, then they can send you an email and say, hey, why don't instead of paying 20% on your credit card on low balance, we'll offer you a personal loan at a fixed 15% rate and we'll give you $100 as a sign up bonus if you do it, right? Like, and so they have these more direct marketing tools where from a consumer standpoint, like those make sense. Now, not everything that they do is really targeted advertisement, right? Like I don't have any student loans, and so I still sometimes like get emails from SoFi that say, hey, you could refinance a student loan, right? So they don't always do that. But they do use that in a lot of ways to try to target to do targeted advertising rather than just kind of giant email blast to everyone.
I'm a SoFi member since of August of last year, 2021. I keep on thinking of my experience back at Wells Fargo for 10 years. Like the only relationship I've had with that bank was them charging me $35 for an overdraft fee. And
Yep.
then as soon as I like become 21 years old and I want to actually like become a grown up and get a grown up bank account where I'm not doing all this silly like stuff and see what's out there because I'm just new to the whole banking experience. I sit down and they try to sell me on student loans when I already had like my my college like situation at that moment like figured out, and it's just like man, like I'm trying to like I don't know, it just felt really
You were the grown
pushy.
up in the room was the problem, right?
Yeah, I was the grown up, and they were just trying to like force feed me different products because they were gonna get a commission or something like that. And now SoFi is just like it's like it's here if you want it. You can use another mortgage, but it's so easy to use ours, and we're also offering it at a lower rate because we know you're gonna be back in the future. Um,
And some of their
but
ads are like the pop-up ads when you open the app sometimes do get a little like I mean, sometimes it's a little pushy. Like honestly, there's things about every company that
mhm.
are right. Like there is a bear case that exists and there is a reason for it. But in general, I agree with you. It's not as like I don't know. I like I had the same exact experience with Wells Fargo, right? Like the only they were my first bank, and like the only experience I had with them was like randomly, like you'd look at my balance sheet or my account statement, and they'd
Oh
have
my
charged me a
gosh.
fee, and you'd like call them up and you'd be like, hey, what was this fee for? And they're like, go in and I don't know, you just hear typing on the other side. You don't know what's going on. And they're like, "Oh, it was for, well, actually, I don't think that that was a proper, like, whatever." And then they're like, I'm like, "Can you reverse it?" And they're like, "Yeah, we'll reverse it for you. It looks like it was an error." I'm like, "How can you just have an error that cost me $40 and you can't explain to me why it is that you took away my $40, right?" Like, and that
Yeah.
sort of stuff happened pretty often, and so I got frustrated with them.
I remember a time I was on the Wells Fargo banking site, and I had like bank statements that went back like 5 years, and I wanted to download them all and just have them in a file on my desktop or something like somewhere. And so I went to the website and I downloaded the first one, and then it would take me to a new page, and then I would have to like copy and paste the old window to like bring up the original page so I can download the next one. So I'm like opening like 20 tabs just to like download 5 years worth of bank statements, and it was just so I was just like, okay, I can't do this. I'm gonna call them, and then I called them, and they're like, I asked them, could you just email me like 5 years of my bank statements? And they're like, no, each one of those is a $25 charge if you want us to send it. And I'm like,
Wow.
you're kidding. So out of spite, I downloaded all 5 years, and I just felt so good about
One
it.
by one,
Yeah.
and it took you
Uh,
a half hour.
but just like we look at that and we think, oh, that's a bad company. No, it's they have a bad back end. Like they can't do that themselves. It has to be for some reason that they're charging that much just because they can't do it, or some sort of like back end tech is
There's obviously a
limiting.
lot of friction there for somebody,
Yeah,
right? Like,
yeah. Well, you said barricades a moment ago, so let's talk about like why SoFi is like a resilient company. You've written a lot of articles talking about their lending, stock-based compensation, student loan moratorium, and how it affects the business. Can you like start off like what you what do you think is the most appealing part of SoFi, and to survive this macroeconomic environment at this moment?
the most appealing part of SoFi to survive the entire macro, I think, is their optionality. So they have, because they have so many different products that they offer, they can lean into different verticals depending upon what the macro environment throws at them. So, and in some ways, they've kind of been hurt by things that were out of their control, right? Like the student loan moratorium. But in the current environment, right, they're raising rates, and that hurts lending in general because now if I'm a borrower, right, and I go to a bank and I say, "Hey, I want to take out a loan," the bank's going to be charging me more now than they were 6 months ago because rates are so much higher. And so in general, that decreases the demand for loans. And so you see that like in mortgage originations, right? Mortgage originations have fallen off a cliff, and a lot of that. So part of it is, well, the biggest part of it is that people stopped refinancing because there's a whole cohort of people who now have an interest rate like 3% or lower. And why would you refinance that, right? And then housing has come down and people are buying less homes. It's actually a tailwind for their personal loan business because as rates rise, you have variable interest debt like credit card debt that is now getting more and more expensive. And so people look at their credit card statement and they realize, holy crap, I'm spending a bunch in interest. And if rates continue to rise, that amount is just going to keep rising. And so you can refinance or consolidate that debt or other debt that you may have that has variable rates into a fixed rate loan like a personal loan. And so they've really leaned hard into personal unsecured personal loans during this time when there's a tailwind for that. And eventually there's going to come a time when rates aren't going up as fast, right? And so they won't have that specific tailwind, but they'll be able to pivot into something else, right? And when as rates eventually fall, assuming they do eventually fall, nobody knows. I certainly don't know. But if they do, then all of a sudden the refinancing business starts to get a tailwind there, even if their other businesses, falter. And right now they're really leaning hard into their SoFi checking and savings account because they are giving a much better APY than everybody else, and so they're growing deposits much faster. So if we go to this is SoFi deposits versus uh, so obviously the x-axis isn't quite the same here. So they got their banking charter, and the first time they reported their deposits was in March of 31st of 2022, and that's where you see that it's just above like $1 billion in
This
deposits,
is
right?
all the SoFi members' direct deposits. This is how
So
much
this is
money
their
is
total
flowing?
deposit. So this includes the, checking, savings. It also includes like the CDs that they give out, and then there's some other smaller categories too. But the biggest portion of it is the deposits they get from people who have checking and savings account. But on the
Wow.
left
And
you
this
see,
is within a year.
so yeah, this is within 6 months, right? So in 6 months from, the end of March to the end of September, they grew from just over $1 billion in deposits to just over $1 billion, or just over $5 billion. And
Wow.
then on the right, if you look at, so this is the quarterly change in deposits, all U.S. banks, and this goes all the way back to 2013. Um, but this last bar, which is like, negative $400 billion. So that's the exact same. That's during the second quarter of 2022. So during the time when SoFi is like tripling their deposits, is the exact same time when banks overall in the U.S. were losing $400 billion of deposits, right?
Wow.
And so like this is an example of how they can lean into one of their verticals when it has a tailwind. So right now they're giving 2.5, 3% interest, and my Chase account, which I still keep open in case like I need to deposit cash, which hasn't happened for years. I don't know why I keep it open, but I do. Um, but that gives me like 0.01% interest, right? And so it's just an example of how they're able to pivot to whatever makes sense. And so there's other companies, so places like Upstart, right, are very, very dependent on just one vertical. And so SoFi can pivot into all these different verticals depending upon what they see in the marketplace. Um, so I think that's why they're resilient. Now, to get back to the actual lending, so lending is kind of the core business that they're operating right now as far as the revenues and profits are concerned.
Hmm.
So I think, and I agree with you guys, and you guys actually do a better job of covering like the technology segment, um, where you talk about Galileo and you talk about Technisys and the opportunity there. And like if you're really bullish on SoFi long term and wanted to become a 20 bagger, it's gonna have to like that part of it, the technology segment, is really where that reward could come from,
Hmm.
right? That's the part that could truly explode and make this a
The
huge
so-called
stock,
AWS of
right?
tech.
The AWS of fintech part, right? Um, because that can scale so much bigger than an individual bank can, because they can sell to all these different fintechs and financial institutions and even legacy banks and stuff. But right now, that's not what is like. Right now, lending makes up a much smaller portion of the business than revenue, right? So it's similar to like Amazon used their retail industry to drive the R&D that eventually then became the AWS, and now AWS is their cash cow, right?
Hmm.
SoFi right now is using lending to drive growth and to drive revenues and profits that they can then reinvest into the technology. And so like right now the truth is that SoFi, like their quarterly earnings for the next year to 2 years are going to be highly dependent on how their lending business does. That's
Hmm.
just kind of the reality of the situation. And so that's why a lot of times I look more, that's why I want to understand that business, is because I want to understand right now what is the business case like. If we're going to look at the fourth quarter results, like where is the growth going to come from? And it's the truth is that most of it's going to be lending, because right now that's 75% of their revenue. It's just the fact of the matter.
So I got a question. So like right now, the deposits grew just drastically in the past 6 months. So technically, they can lend out more.
Right.
So and because they have more members, they have more members to lend to. Um, when is this direct deposit multiple stop? Do you know like because I guess there's a mass wealth transformation from the traditional banks direct deposits from the graph you showed to SoFi and other banks like SoFi, neobanks, I would assume.
On the big scale, so $5 billion is like nothing in deposits to like JP Morgan Chase. They have like trillions of dollars of
Yeah,
deposits, right? So it's not like right now JP Morgan Chase is looking at SoFi's deposits and
yeah.
thinking that's anything, right? Like
Mm,
it's like a micro millizilch of what JP Morgan has. Um, but to answer your other question, like the fact that they are growing is a big deal for SoFi, right? And the fact that they're taking market share is a big deal. When everybody else is losing deposits, they're gaining them. It shows that they have a competitive advantage right now in that space. But to answer your first question of how far does it go, like in theory, like there is no limit to how much they can benefit from deposits, because if they get the biggest portion right now is getting to the point at which they are using deposits as the collateral for all of the loans they hold on their loan book. Because right now, so SoFi can originate loans from three different buckets right now. So one is their own cash. So SoFi has um, about $3 billion ish in capital that they can just loan because they have that much money. And right now, about 2 billion of that is tied up in originated loans. So they've loaned out their own money for a personal loan or a student loan. And that's their cheapest source of capital because it's theirs, right? The second cheapest bucket is going to be deposits. And so because they're a chartered bank, they're able to use deposits as collateral for loans. So they're at about 5 billion right now. So that $5 billion of their loan book they can cover at the cost of whatever they're giving to us, their members, in APY. So the cost of capital there is 2.5% or 3%, depending on how much you have in checking or savings. Or if you're not a direct deposit member, then it's a little bit less than that. But the point is that these are interest-bearing accounts, but it's still their second cheapest source of funding for their loans. And then the third bucket is warehouse facilities. So these are like other banks who are lending SoFi money. So they've got a contract with these banks that say, we'll be able to lend you this amount of cash at this rate. And right now, those, as of Q3, those cost SoFi about 125 basis points, which is 1.25% more than their deposits. And so
Wow.
every week right now, SoFi is building their deposits. It's at about $170 million per week, is what, like, if you look at the slope of that graph that I just showed,
Yeah.
it's about $170 million per week. So at $170 million per week, and they're saving 0.0125, right? So 1.25%. So every single week, if you take it on an annualized basis, they're growing their revenue for next year an extra $2 million just by growing their deposit base by $170 million a
Because
week.
lending is getting categorically more cheaper for them to do.
Yeah, because it's just
Because
cheaper, right? Like so they're
wow.
saving 1%, but 1% doesn't sound like a bunch, but when you're holding, like, what's the number now? I think it's somewhere they're holding a little over $10 billion of loans on their book. So 1% of $10 billion is $100 million, right? And so, like, if they can get the deposits to, so right now they're at $5 billion of deposits. If they had $10 billion of deposits without doing anything else other than having that money, they'd be making an extra $100 million in revenue each year, like an extra 125.
That's insane. So I mean, and they're like blitz scaling their advertisement. They're trying to get as many heartbeats into this app as possible. Uh, I feel like advertising is cheaper now too, since like money isn't free.
Yeah, I think,
So
yeah.
so
Hopefully
far,
that they'll be able to scale, right? Like hopefully their advertising costs will come down. And
mm,
they've stayed pretty level in terms of, like, if you look at consumer acquisition costs over the years, like we're actually slightly, the SoFi is actually slightly higher in 2022 year to date than they were in 2021. Um, but I hope you're right. Like, it seems like from everything else we're seeing that ad spend is going down elsewhere. So hopefully they're able to take on some of that ad spend. I mean, they're hiring when other people are firing. And they're continuing to grow when other people are contracting. So if they can take advantage, if they can continue that trajectory where they're growing and they're spending responsibly and they're acquiring customers, then they'll be able to. Because for them, again, like, each incremental direct deposit customer is worth a lot of money to them
mm,
because each one of them is saving them money on their loan book. And so I guess to get back to the original question, so the biggest point is once deposits are higher than their loan book, that's where they're going to see the biggest bang for their buck on deposits. But past that, you can still use deposits if you're a bank to, like, lend out to other banks and to do other things with to make some net interest margin right there. And so
Mm.
there's still a value to that, but the biggest value is going to come between now and whenever they have enough deposits to make it so that they don't have to use warehouse facilities anymore.
I wanna touch on, you said earlier competition, and you've wrote an article about Upstart and Lending Club and SoFi, and just comparing those three. Like in Upstart, if you look at the stock history for the past 2 years, it is
Yeah.
a triangle. It's
Yeah, no,
just
it went, so
ugly.
it IPO'd at $20. It went all the way up to $400, and now it's come down and it's like at $19. So it peaked at like just barely over $400. So it
Oh
was
my god!
20x, and it was like less than a year. Um,
And
and now it's
and
back down below its IPO price.
and
Um,
all of that was hype, even though like SoFi looks as though like it has a way cooler business model long term. In my opinion, Upstart got like tons of capital just because of their AI or machine learning.
so
um,
I actually think Upstart has a good niche, but it turns out that that niche really sucks in an environment, a rising rate environment. So,
yeah.
all three of those companies, so Upstart like gets a lot of press for its AI model, but SoFi and Lending Club also, when you go and you apply for a loan at both of those banks, they have their own AI machine learning models that actually
Mm.
go on in the background to approve you. And I am certainly not qualified to be able to tell you which machine learning algorithm is better, right? Um, but Upstart, so the business models are completely different. The Upstart started as just a referral business. So people would
Mm.
go and apply for a loan, and they would either they would approve them at some rate or say, no, you're too risky or whatever. And then the loan wasn't originated by Upstart. They didn't have any capital risk on their balance sheet to start. And in a really low rate environment, so hedge funds and other things were buying up their securities on the debt markets like they were candy. Um, and so they were able to just churn and grow like crazy. And they didn't have, and none of their balance sheet was at risk, right? They weren't taking on any risk for these loans. They were just collecting a bunch of referral fees, basically. Um, and then rising rates hit. And the thing about Upstart is their target market is subprime and like near prime people who are looking for personal loans. So these are like the riskiest. These are like 650 and lower FICO scores.
Mm.
Um, and so those are risky because those people default more. The point Upstart's business model is, hey, look, but what we can do is we can identify the people who are in this cohort who aren't as risky as their FICO score would actually say they're supposed to be. Um, and their algorithm does perform, right? Like they have like the data that they've published all seems to indicate that they're doing a fine job of what they're doing. But the risk appetite has completely shut off. So all those people who were buying all their loans were like, no, thank you, because rates are rising. These people are going to default at a higher rate, and so we're not going to buy that anymore. So all their referral money, like all their referral fees, just went down because their originations just crashed. Here, I'll pull up another chart kind of as we're talking through this. But the thing, so I don't think Upstart at these levels is actually a bad buy. I actually think it's a decent buy because they've completely crashed, and also because their problem is funding, right? So they need people who are going to buy those loans. And right
Mm.
now, and so they're actually building a large network of like credit unions and local people who don't like. So if you're at SoFi, you can build a machine learning model because you've got software engineers, right?
Mm.
If you're at your local credit union, you're not going to go out and pay a software engineer to build you a machine learning model, right?
Yeah.
But there are
Yeah.
tons of credit unions. There's tons of people who want their local branch to be their bank. And
Mm.
so if those local branches like can use Upstart's technology to get more bang for their buck on their loans, that makes a lot of sense for a credit union, right?
Mm.
And so Upstart's, I guess, they're trying to kind of pivot towards these much more secured funding sources, rather than like hedge funds and risk on debt market, like the ABS markets and stuff. They're trying to pivot and go more towards credit unions and small banks who don't have the technology to do this on their own. So we'll go. So here's a graph. This is unsecured personal loan originations. The red is Upstart's. the green is Lending Club, and then the blue is SoFi. So if you look at like Upstart was just growing like crazy, right? So you go from the third quarter
Wow.
of 2020, they were under $1 billion in originations, and then by the first quarter of 2022, right, which is a year and a half later, they're at over 4.5 billion. But now they're back below they were like throughout most of 2021, and so you can just see that it fell off. It completely fell off a cliff, right? Like
Mm.
because just because all that funding dried up, and people weren't willing to take a bet on these lower quality loans. And then Lending Club, so the next step up is Lending Club. And Lending Club, I guess the next step up in terms of FICO score, right? So Lending Club has their business model is slightly different. They are a chartered bank, and they lend to people who are serial users of credit. So they have this cohort of people who have taken out, lots of them are return buyers. So they'll take out a loan
Hmm.
from Lending Club, they'll pay it back, and then eventually they'll kind of come back. Um, and they're the kind of their credit box. So they go anywhere from like near prime to like prime plus. So anywhere from like 680 to say 750 is kind of their core um, target market. And they have two, so all of the really good high quality loans that they originate, so they hold in the bank. So they say these are the least risky assets that we've originated. We're going to hold this in the bank. And then the rest of them, which are all kind of lower, they also sell on the marketplace, similar to what Upstart does, right? But they're a little bit higher quality, so they're a little bit more resilient. But Lending Club's business kind of it's been more resilient because their FICO scores are harder or higher, and so they were able to keep their originations growing for a little bit longer. But they saw the exact same thing happen as what happened to Upstart, and the cohort. So the cohort that they hold on their balance sheet is like 730 average FICO score. The cohort that they sold to everyone else is like 718. So like they keep the best ones for themselves, and then they sell the rest of it to like these debt investors. And then SoFi has the highest quality of all. So that the average, FICO score from their personal loans last quarter was 746. Um, and so it's this really high quality cohort, so higher quality than Lending Club. And also SoFi does it differently. So SoFi, when they originate a loan, they keep it on their balance sheet and they keep it there for 6 to 7 months is what they guide for. And then they'll sell it, they'll securitize it, or they'll just sell it on the wholesale loan market to debt investors. And then so whereas both
Why do you
Upstart
think they
and
do
Lending
that?
Club,
Why do you think
why
they
do they
hold
do
it?
that?
Yeah.
So
What's the
they hold
advantage?
it so that they can earn net interest on it, right? So their loans are somewhere around the mid-teens
Mm.
in in interest rate, and so and they're paying somewhere between either 0% if it's their own capital, like 2.5% if it's the deposits are like 3 to 4% if it's their warehouse facilities. And so that difference, that delta between the two of them, between those two, is what they take in their net interest margin. And last quarter, like they made 12% on their personal loan portfolio in
Wow.
terms of net interest margin. Um, so they make a bunch of money in net interest on those loans. And so the longer they're able to hold those, so they moved from before they had the bank charter, they only held them for like 3 months. Now they're moving to 6 months. And the reason why is because now they've got their access to funding has grown a bunch because now they've got this extra $5 billion in deposits that they can use to originate more loans. So now they can hold things a little longer before they sell them. And then when they sell them for more than they originated for. So on like the last couple of earnings calls, one of the analysts keeps asking Chris Lapointe, the CFO, and says, "What's your gain on sale margin?" And I don't. Lots of people I don't think understand what gain on sale margin even means. But essentially, so a gain on sale margin is if I can SoFi lends $100 to you, and then they collect interest on that for 6 months, and at the end of 6 months they go and they sell it, but they sell it for more than they originated it for. So if they originated $100 in loan, they'll sell it for about $104. And so there's two ways that they make money on their loans. So they make money in interest while they're holding it on the books, and then they also make money when they sell it, and that's called gain on sale margin, and it's been around 4 to 4.5%.
Hmm.
And so that's the non-interest revenue is how they
And I
classify it.
assume, like, since they have data that the person is paying these loans for the past 6 months, that when they sell it, it's like a higher rating. Does that like account for it? Like the people that buy it, they're like, do they see that trend? Do they
Yeah,
pay a
so
premium?
and there's all kinds of data that they have to publish. So or that they give. So they give FICO scores, and obviously, if they've held them for 6 months, some of these are going to go into delinquency, right, during that time. And so they say, this is the average size of the loan, this is the average um,
Hmm.
salary of the people who have it, or household income, and this is their FICO score and everything else. And they give that information when they're selling the loans, and higher quality borrowers demand a higher premium, right? And this is one of the risks, honestly, with SoFi right now, is the fact that like you've seen this tail off, right? Where Upstart started off and they were going like gangbusters, but when debt markets kind of when demand destruction occurred in the debt markets, they were the first to go because they were the lowest quality. And then Lending Club has so their in-house originations is fine because they're just holding them on the books. But their marketplace revenue has also decreased, and that's why they saw a decrease from Q2 to Q3 in their originations. Is all of that was in their marketplace, so the loans that they sell. And SoFi is more resilient to this because they have the highest quality borrower of all, but they're not completely immune, right? So like
Mm-hmm.
if things break in the banking system, if things really deteriorate in the macro environment, like there's nothing guaranteeing that they won't have a hard time selling their loans. And if they can't sell their loans, they won't originate new ones. And so if their originations come down, then that will affect their lending revenue and income. Because so they rather than kind of so both Upstart and Lending Club have kind of these parallel paths where they originate to so Upstart originates to their bank partners and then to like hedge funds and other people who are buying it. Lending Club originates and holds a bunch on their balance sheet to maturity, and then they also have a marketplace. SoFi's is kind of different. They're like a spring, right? So they absorb all of these loans onto their balance sheet, and then they can adjust that spring based on like how much they sell to debt markets.
So it's kind
But
of like,
eventually, if they keep absorbing more and more loans, right,
oh,
it's just compressing that spring. And if they can't sell it, so that's the risk, is that if they can't sell it, eventually that spring gets so compressed that it can't compress anymore. So they'll have to decrease their originations, and that'll
hmm.
hit their revenues and
So that's
income.
why it looks super stable on that chart you showed. It's just like uh, just them. Would you say they make like 12%
Yeah, so they
on?
make about 12%. And the chart I showed was just origination volume. So that's just
Okay,
how many they originated in that quarter, how much each of those company originated in that quarter. Um, and the revenue, if you look at net interest in revenue, it's also gone up over time a lot because so when they held like $6 billion of loans when they got the bank charter, now they're up to 10 billion
wow.
because they're extending their hold times. So that means that the amount that they're holding on the balance sheet is going to grow.
And that
So, but that's
12%
a
should
portion of
grow
why, yeah. So, and the
with the.
12%. So this is actually something that that's really bullish about SoFi. So Lending Club in their last call, and this takes a little bit to explain, but Lending Club said what they're seeing is since the start of rate hikes, the Fed has moved 300 bips at this when they reported. So they've moved rates 3%. Um, Credit cards have moved about 2.5%, so 250 bips. And then Lending Club has only moved their rates 2%. And so, and the reason why is that the explanation that Lending Club gave is so the Fed raises their rates, and then there's a lag between that and when banks raise their rates on the credit card. And then that's what actually drives revenue for them or drives demand from borrowers for them because if I'm a borrower or I'm looking at my credit card statement, I don't see that rate raise. I don't see that
Mm,
like it doesn't hit my bottom line until at least a month later because that's when my credit card statement comes out. Right? So
yeah.
even if the bank raises my interest rate on my credit card this month, I don't actually see that I'm owing more money until next month. And so there's a little bit of lag there. And then then I see that, and then I see that for a couple months, I think, oh crap, I should probably get a personal loan instead of holding this rate that just keeps going up and up and up. And so Lending Club saying, hey, the demand for our loans lags what the Fed, excuse me, what the Fed is doing.
Mm,
But when you look at SoFi, if you look at the net interest margin, theirs is actually so that the end effect of that is Lending Club is actually seeing compressed margins right now because they can't move their rates as fast as the Fed is moving their rates. And so Lending Club's cost of capital moves more in line with the Fed funds rate because they're a bank. Um, but they can only move their personal loans on this lag. But SoFi, their demand from borrowers is so robust that they've actually been front running those rate hikes. So SoFi
Wow.
actually increased their net interest margin from Q2 to Q3 by 60 basis points.
60?
So they made, yeah, so instead of like in Q2, they made 11.6% on their loans. And in Q3, they made 12.2% on their loans
Wow.
or something. Those might be off by a couple percentage points, but I know the 60 bips is right, the 60 basis points. And so, but the other thing that's actually really super bullish about that is half of those loans were loans that were already originated. So they were at the same level, and now the entire average has gone up 60 basis points, which means that
Wow.
just in Q3, that means they raised them way more than just 60 basis points.
So it's a sign that it's going to be growing continually,
So
or
it's a
not.
sign that their demand is really strong from the borrower side.
Hmm.
So they're taking market share. So all these other personal loan companies are seeing their origination shrink, right? So uh, yeah, Upstart's down like 50% over the last 2 quarters. Like they've lost like half of their originations. And that's again just that's the market that we're in and their clientele. Lending Club was still growing, but from Q2 to Q3 they dropped 8%. And SoFi from Q2 to Q3 increased 14%. So they're still growing originations, and at the same time, their spread on those loans is getting higher. So
Wow.
they're increasing their net interest margin, they're making more per loan, and they're still able to keep growing their loan, like their originations, in an environment where everybody else is shrinking the amount of loans that they're originating and also shrinking the net interest margin that they're actually um, the amount of money that they're getting off of those loans. So from the borrower side, things look great, right? Like, um, and I think kind of the three reasons that happens is SoFi's access to funding is growing. We've talked about that with the deposits, right? So they've got this bigger pool they can lend from. They also have significantly bigger member growth than like, for example, Lending Club. And I don't want to disparage Lending Club. I think they have a great business model, and I actually own Lending Club shares. Like, I don't think they're a terrible company by any stretch of the imagination. But Lending Club in this year is going to grow their member base by 400,000 people, or they call them members too, so 400,000 members. Whereas SoFi is growing their membership by 400,000 members per quarter,
Yeah.
right? So the last 6 quarters has been over 400,000 members. So they're growing their member base at least 4 times the rate as Lending Club. And so you have this
Wow.
much bigger base to draw from. So it makes sense that you're able to then, like, you can keep growing originations because now you've got a bigger pool of borrowers to draw from. So that's kind of member growth grows that, or member growth is kind of the second thing that helps them out a lot in this current environment. And then the third thing that I think will help, and this is the part that's unproven, is the fact that since they have a higher quality of member, I think they're going to be more robust from so there's demands from borrowers. There are also demands to buy the loans, right? That's a completely different cohort. That's these, hedge funds and other people who purchase um, these bonds that like the personal loan bonds that sell. And so if they're going to be more resilient to swings in demand there because their borrowers are higher quality, but it's not necessarily like if liquidity seizes up in there, then that is a risk to their lending platform, right? That's a risk to their revenues and stuff. Does that make
Um.
sense?
Yeah. No. No. It does. It does. It paints a better picture for me in my mind. But I do want to get your take on the student loan moratorium, and
Okay.
let's say what would happen to SoFi if the student loan moratorium ended tomorrow. What do you think? What would happen? I know that's kind of a loaded question.
So, um, so in a rising rate environment, that's really bad for student loan refinancing because there's less people who are going to gain from it, right? So if I've got a student loan and it was, I don't know, 6% interest and it's 2020 and I could refinance that at 3% interest that saves me a bunch of money. Um, but now it's 2022, and now I can't refinance. I can refinance my 6% loan at 5%. There's a lot less impetus for me to go and
Mm.
refinance that loan. And so as rates rise, it shrinks the size of the total addressable market just because there's less people who can benefit. Um, but I don't have insight into the size of that total addressable market, whereas Anthony Noto does, right? This is their business. And so he said at this conference, he said there's over $200 billion of total addressable market of people who would benefit right now from refinancing their student loans with a SoFi loan. So that's still a huge total addressable market. And then he also said, we expect like that loan originations will get back into the high ones to low $2 billion. Um, and so that's about 4 times as big as it is right now. And so I guess to answer your question, this is a cop out a little bit, but if I
Yeah.
want to lean on Anthony Noto, that's what he said. Now, my personal opinion is that SoFi always under promises and over delivers. Like that's just one of the things that they consistently do. Like it's just they'd rather do that than the opposite, right? And
Yeah.
I think that they'd get to a higher rate than that. So when you think about it this way, so back in Q4 of 2019, and I actually have a chart. So this is their student loan origination volumes from all the way back pre-pandemic to where it is now. And so you can see like pre-pandemic, they were growing this and they actually peaked
Wow.
out at $2.4 billion. And then March of 2020 is when the loan moratorium hit. So in like that's why you see kind of a little bit of a step down in the first quarter of 2020 is because about 1 month of that there was moratorium. And then it just falls off a cliff, right? Like it just goes down to 1 billion and it stays there for a while. And then you get this little blip in the fourth quarter of 2021 and that's because the administration was saying, "Hey, we're going to restart start loans for sure on January 31st, 2022." And so people started to get ahead of that and said, "Okay, we're going to refinance our loans because rates were starting to rise at that point." And then the Delta variant came out and they said, "Just kidding. The student loan moratorium is going to keep going forever." Um, and so then it fell off a cliff. And I don't actually have the third quarter numbers on here, but it's even lower than those second quarter 22
Wow.
numbers.
That's incredible.
So it fell completely off a cliff. And so I think like here's the other thing that like I don't think people take into account when they look at these numbers. In fourth quarter of 2019, SoFi had 1/5 of the members that they have now. So SoFi it was below uh, um, it was below 1 million members in fourth quarter of 2019, and they originated almost $2.5 billion of student loans. And now they by the time student loans restarts, whenever it is, and it's possible that it's going to get pushed out further because of all this loan forgiveness going through the courts and stuff. At some point in the future, student loan payments will resume. And Anthony Noto guided that we'll get back up to about 2 billion. The reason that I think that that's a lowball estimate is because we have 5 times as many members now as we did then. And it seems like you should be able to get, and I recognize that like rates have gone up, and so the amount of people that are going to benefit has decreased, but I don't think it's decreased 5x. Like I don't think it's
Yeah.
decreased as fast as the membership has grown, right?
Yeah.
So I wouldn't be surprised to see something in the between, 2.5, 3, maybe even $3.5 billion in originations in student loans. And if that's the case, um, like if it does get to that range, even if it gets to like 2 billion, that's going to be something like I don't know. I did these numbers a long time ago, but it's on the order of like an extra $100 million in revenue every single quarter. It's
And
maybe even more than that. But if it gets to like 3.5 or 3 or $3.5 billion in originations every single quarter, like that's going to be a huge tailwind for the business, and it's going to pull profitability and growth up a ton. And I think that that's a reasonable scenario.
I also think that
Sorry, I give really long-winded responses to all of
no,
your
no, no.
questions.
This is something that I'm really lacking in the knowledge when it comes to SoFi. I focus primarily on the tech side, but I think that the student loan like moratorium, once that's lifted, a bunch of students are gonna want to come to SoFi, and this is like their prime target like audience of people that they want, because all the like the FICO scores do not give students justice for their human potential of capital that they're going to be making in 5 years from now, which is kind of how like the whole SoFi model was based off of, that there was an opportunity there. And I think that, and as soon as like they get their first job out of college and they start getting that SoFi Plus membership rewards, it's just going to be super sticky. It just see their total members growing quarter over quarter even more because of the moratorium
No, I
ending.
agree. I
Yeah.
completely agree. I think that because before the student loan moratorium, honestly, their primary growth driver was exactly that. They like went onto campuses and did events and like
Mm,
they like the student loan student loans weren't just their growth driver for the lending business, they were their growth driver for their membership business, right? Like they were like, well, okay, we'll get these people in the door, we'll refinance their student loans, and then they'll be our members for life because we offer a great sticky
yeah.
product, like you said. Um, and so I think I agree with you. I think that they're really going to lean into that, not just because, and student, the thing about SoFi is they've totally moved on from student loans from like a financials
Crazy.
perspective.
Yeah.
Like it doesn't matter how long the moratorium gets extended because SoFi is growing 50% without it. You know,
Yeah.
like when it comes, it will be this huge, massive tailwind, both in terms of these originations, which are going to drive revenue, but also the fact that this was like they were really good at marketing to these to students and making them members, right? And they'll
Mm,
be able to do that again. And so it's another thing that they're already super competent on that will just be added back into the mix and drive growth. And actually, it's kind of, while we're talking about it, so this is something that I really don't think people realize when they talk about SoFi and about SoFi's growth. So this is like the hero product of different companies that everybody's heard about, right? So on the left, this is the amount, these bars are the percentage of total revenue from that hero product. So this is like the main thing that a company sells, right? So in the fourth quarter of 2019, SoFi's student loans made up something like 65% of their total revenue, right? So it was well over half of their total revenue. That compares to, so iPhones are like half of Apple's revenue, right? Nike, their entire shoe business is the exact same as in terms of like percentage revenue as SoFi students loans were. It's about the same as Starbucks. It's like
and
a
this is
little
not
bit less than
today. This
Tesla's
is
cars.
back
So
in
these numbers,
2019.
the SoFi numbers are back in 2019. The other numbers are from today.
Okay. Okay.
So everybody else's numbers are from today. And on the right, you've got Disney, right? And that's like all of their parks, all of their
Wow.
experiences, like all of the products that they sell is like 33% of what they do right now. So imagine, right, what happened in the second quarter of 2020 is that bar on the left got cut more than in half, right? It got cut 75% basically.
Wow.
And so like imagine if you took Apple today and you took away it's 80% of their iPhone sales. And not you took them away not just for now, but for the entire next 3 years.
Mm,
And then so let's fast forward in 3 years. So it's the end of 2025 now, and you look at Apple and you look at their revenues, and they've tripled in that time without and they've had those depressed iPhone sales the entire time. That's ridiculous, right?
yeah.
Like that couldn't happen. Or if you look at Starbucks and you said, okay, Starbucks has to stop selling 75% of their coffee and they can't sell any more coffee than that for the next few years. And in fact, the amount of coffee that they're going to sell is going to decrease over that time because that's what's happened with student loans. Like, and then you fast forward 3 years and somehow they've grown 50%, like they've tripled their revenue over the time. Like that's what SoFi did. They took the hero product through no fault of their own, got taken away, right? So like you take 65% of their revenues, you cut that down 75% in total, and then you keep it there for 3 years. And so at the end in 2019, they made they made like $500 million in revenue. By the end of 2022, they will have $1.5 billion in revenue. So
I'm
they'll triple
so.
revenues with like losing their main product.
How did any other? Were there any other student loan refinance companies that just didn't survive this? Like, I feel like there has to be some sort of competition that SoFi had at one point that just did. Like, they couldn't have adjusted to this.
There were
As
some, I think there's some that have
because
gotten out of the business, right? Like because of
wow,
this reason. So there were a couple, and Bender's actually the right person to talk about this. He knows this off the top of his head.
yeah,
So we should message him. Um,
that's a whole topic right there.
that's a whole topic all by itself. Um, but there were other companies that did lean into student loans, but like and they pivoted completely. I think that company, I can't remember what the name of it right now off the top of my head, but they're like doing solar loans now, right? And
Oh
their
wow,
entire revenue has just like collapsed because they
wow.
were built on this model, right, of student
SoFi's,
loans. And
I feel like when the student loan moratorium ends, SoFi is going to be like the only like great choice out. They're going to do the LTV of their customers are so high that they're going to be like they're going to just grow like rapidly, or they're going to have the best like option.
yeah,
Or
the thing is that like it's a business that's already built. That's the crazy part, right? Like they've got this business that's completely built, completely vertically integrated. It's in their back pocket. It's just waiting there, and it's going to keep
yeah,
waiting there. And I'm not worried. Like if the student loan moratorium hits, SoFi stock price will probably drop again because it's bad news, right? Like that's the worst news
yeah,
SoFi could get, and it's been the worst news that they could get over and over and over for the last almost 3 years now. But like I'm investing in SoFi for 3 to 5 years at a bare minimum and probably more like a decade, right? So
yeah.
like I don't care when the moratorium ends. Like I'm gonna bet that in 5 years it's gonna end, like sometime in the next 5 years. That seems like a safe bet, right?
That
Like
is a safe bet.
and so like it may come back on January 1st, right? That's when it's scheduled to. This is the final time, but
Yeah.
this is like the fifth final time. And so like it's probably gonna if the courts keep extending things, it'll probably get extended again. But eventually it's gonna come back. And when it does, like SoFi has this ace up their sleeve that everybody knows about, but that is going to just absolutely boost their growth. And whatever year that is that it comes back, like you'll see this outsized growth rate
Mm,
because because of that.
yeah. Um, Real quick, let's talk about stock-based compensation. What your take is on that? There's a lot of people that really hate being diluted by SoFi but the SoFi at the same time is trying to acquire a lot of high-end talent that will probably pay dividends in the future. So, what's your whole take on that? What is?
So I don't like getting diluted either, right? Nobody likes getting diluted because your share of the company goes down, right? So if it's a $5 billion company and they dilute it 5%, and the company stays at $5 billion, now even if or even if the company grows and now it's worth 5% more, my shares in that company are worth the exact same thing, and that sucks.
Mm,
But the key to I guess the key, how I view stock-based compensation is what is that stock-based compensation paying for, right? So what are
mm,
the results? So if I were to, so like if I'm a small business owner and somebody offers me a 5% loan and I know I can grow my business 40% off of that 5% loan, then I would take it in a heartbeat, right?
mm,
Because the net that I'm making off of that is way more than the cost of the loan. And so that's the way that I view dilution is through that lens. The point is dilution on its own is bad in a vacuum, right? You don't want it. But
mm,
if that dilution allows you to acquire talent and allows you to build a company that is growing significantly faster than the dilution, then I'm okay with it. Because as a shareholder, I get to benefit from that growth. And so I ran an analysis at the current amount of stock-based compensation. We're probably talking about for 2022 as a whole, dilution is going to be somewhere in the range of 5 to 8%, um, which is a lot, right? Like
mm,
that's a big amount. Um, but growth, so revenue growth over that time is going to be 50%. And the EBITDA, which people don't like that metric, but the point is that their net income margin is increasing, right? So they're dropping more to the bottom line. They're growing their top line way like 10x the amount of dilution that we're getting. And so as long as those results continue, then it's okay, in my opinion, for them to continue to give out soft-based compensation. And another thing that's kind of important, I guess, while we're discussing it, this kind of shows that principle with actual numbers, right? So the orange bars are the stock-based compensation. The blue bars are SoFi's revenue, and then that green line is the stock-based compensation as a percentage of revenue. And so right now, SoFi's stock-based compensation increased a lot when they went public. So that's the jump from like second quarter 2021 to third quarter 2021. And then it's pretty much leveled off and stayed pretty much flat, somewhere around $80 million a quarter. Um, but their revenues continue to grow at a much larger rate than the
Hmm.
stock-based compensation. And so at this point, in the most recent quarter, they were somewhere around 18% of their revenues was their stock-based compensation. They've guided for the end of like in 2024, that will be down to single digits. And the reason why is because the stock-based compensation, as you see here, is flat. And it's like if you look into and run the numbers on what they've guided for, basically it's going to stay pretty close to flat over the next 2 years. But their revenue is they had 50% growth this year. The analysts say that they'll have like 35% growth the year after that, and then the year after that is like high 20% growth. My personal belief is that they'll grow even faster than that. But even with those growth rates that the analysts are looking at, the the stock-based compensation as a percentage of revenue will be down below 10% at that point. And
So
so,
you don't
go
really
ahead.
have a problem with the stock-based compensation. It looks manageable in the long term.
Yeah, I think it does, and I don't have a problem with it as long as it's paying for growth. And the other
Yeah.
thing that like the other benefits to stock-based compensation that aren't like I'm a numbers guy, I'm an engineer, I love looking at numbers, but there is something to be said for like things that aren't quantifiable. And so the point is that the other thing is like if you're giving stock-based compensation to employees, they then have skin in the game, right? Like if if half of my compensation package, and I don't know what the percentage is of their company, even if it's like 10% of my compensation package is in stock, I am then incentivized to build a company that's going to make a return on that stock. And so
Yeah.
each individual employee now has skin in the game, in addition to the fact that this is their job, right? They know that whatever they're putting in can,
Yeah.
have outsized returns for them in the future. So that's like a non-tangible benefit to this is the fact that you also have employees who are now more engaged and have their own skin in the game for the work that they're doing. So as long as, I guess the caveat is, as long as SoFi continues to grow significantly faster than the amount that they're diluting, then I'm not that concerned about it. And that's as far as stock-based compensation. The other part of the equation for dilution is acquisitions, right? So the Technisys acquisition was like 10% dilution. Um,
Yeah.
and
Wow.
there it's more of a question of was the price that you paid. So is in the long term, do you think that Technisys is going to be worth more than the amount they paid for it, right? And judging by what they've done with Galileo, like the only large acquisition they've ever done was the Galileo purchase. And Galileo's current like revenue run rate, I think justifies that purchase and what they've done with Galileo and the
Hmm.
internal cost savings that they've been able to absorb from Galileo. Like if you look at the past history of SoFi and you look at the past history of their large acquisitions, it was a home run. And so I am then more inclined to think that they'll be able to also make Technisys into a home run. And I think and just looking at the Galileo Technisys and Bank Charter trifecta sort of like the fact that they have this very unique offering for fintech companies and for um, neobanks and even like legacy banks, right? They have a very unique offering that they can give where they can be almost the full package for anybody who wants to start a new fintech. Nobody else can do that, right? And so I like my personal opinion on the Technisys acquisition is that it was worth it, but only time will tell for sure. But their track record shows that when they make a large acquisition, they take the time and they make it into a business that was worth the cost.
Real quick, before we wrap up, do you think that there's going to be? Do you think Anthony Noto, just based on what you think of him as a person, is going to be trying to probably pick up some of these cheap fintech companies in the next in 2023 since valuations are probably pretty good. Because Lord knows we have an infinite amount of products that we're going to try to build sooner or later.
Yeah, I my personal opinion, I think it's pretty clear that they want to, and their vision for SoFi is to vertically integrate each of their products,
Make
right?
everything
And to
cheaper. Yeah.
own the tech that goes behind it. Like they've made
Mm.
that pretty clear. That shouldn't be news to anybody who follows the company, right? And so it certainly would not surprise me if they made an acquisition. I think, like, I trust him when he says we don't, unless there's something that is like just a slam dunk and we have to do it because the valuation and the value is too good. We're not going to do any large acquisitions until we have Technisys fully into the fold, right?
Yeah.
I think that management's being clear there, and I think they're being transparent. I think he's being honest because it is true that there's companies like Peter Lynch says when companies start buying a bunch of companies, that it's diversifying is what he defines it as, right? So there's a point at which you're no longer diversifying, you're diversifying. And so because you can't manage all these different moving parts, right? Like if you're constantly every single year trying to take on a new business that you've acquired and fold them in and then make sure that everything works and then you're doing that two, three, four times like in a row, there are certain people and there's certain companies that are excellent at that. Like that's one of their core competencies and that's one of the reasons that they've become an excellent business. But for the vast majority of businesses, that's really, really hard and they fail miserably when they try to do it. And so I think that he understands that. But in the same breath, I think they're definitely going to either build or most likely acquire a clearinghouse at some point so that
Yeah.
they vertically can integrate SoFi Invest. They've telegraphed multiple times and he's talked about possibly acquiring a tax company at some point, so, or not tax, sorry, an
Ooh.
insurance company at some point so that
Well,
they
they did
can,
do bindable,
yeah,
where
and
they
they
can
did
white label.
bindable, right? So now they've got a white label provider so that they can, and I think that's a step along that path. But I
Mm.
think at some point they're going to make an acquisition so that they can be the primary on their insurance.
Yeah,
Um,
bindable does offer a solution where you can switch over from bindable to like do your own in-house kind of stuff, which is kind of cool.
yeah, so I think there are. I think that there are going to be acquisitions in the offing. I don't think there's any going to be any large ones in the near term. There might be some small acquisitions that they might do. I personally don't think they're going to absorb someone like MoneyLion or Dave or
Oh
these
yeah,
other things that
yeah.
are like just to get members. That doesn't seem to be something that SoFi is going to want to do. If they make an
Yeah.
acquisition, it's going to be a strategically important one. So Galileo was strategically important so that they could, own the technology behind their products. Golden Pacific was strategically important so
Oh
that they could
yeah,
have a bank
yeah,
charter, right?
yeah.
Technisys was
Very good
strategically
moves.
important so that they could own this multi-core product and so they didn't have their siloed cores in-house. And so, like, if they're going to make an acquisition, it's going to be strategic. But there is a possibility, and like people talk about that shelf offering. They have this shelf offering where they could dilute shareholders up to $1 billion to take cash out.
Mm.
Um, People started freaking out when it was announced.
Yeah.
Um, First of all, a lot of companies do this. This isn't like a SoFi specific thing. Like AMD, like who generates ridiculous amount of free cash flow, has an S3 shelf offering filed. Like it doesn't mean that they're going to dilute you. I think, and this is my personal opinion, right? Like I don't know anything, but I think the only reason that they would use that shelf offering would be to offer to raise cash for an acquisition. And I don't
Mm.
think that's going to happen, but I could be wrong.
It is. It is. I feel like it is possible with all these low valuations coming closer and closer. I don't know where the bottom is, but
Yeah, I
real
don't either,
quick,
right?
I want to shift to what you think the future is going to look like for banking. This is a really hard field to look, especially since it's entirely dependent on U.S. regulations, where in other countries you could just build stuff and as long as it's safe, the government really doesn't care. But in America, we've held the majority of the world's capital for such a long time. We have so many rules that innovation is kind of stifled. Where do you think SoFi could be in 5 to 10 years?
So I think there's a really asymmetric risk reward scenario here. I think that like you're not taking much risk on SoFi right now. Like they're trading at or around book value. Some of that's goodwill from their acquisitions, but even still, like you're getting a company that's growing like crazy and is growing even in like the worst possible environment that you could have for them. Like four straight 75 basis point rate hikes is like in the list of things that would hurt SoFi the most, that's like right near the top. And they're still growing like 50% in spite of it, right? Like
Yeah.
that's pretty incredible execution. And so I think like where SoFi is going to be in 5 to 10 years, I think they get their consumer banking segment to a point where you can't keep growing, 60% year over year
Hmm.
in membership forever. Like that's ridiculous, especially if you want to maintain high quality members. So I think they get to a point where that all levels out, right? And so they still have a lot of verticals to move into. So they've talked about like going into small business banking, right?
Oh
And
yeah.
they could go into, I don't think that this is on the roadmap anytime soon, but they could go into like investment banking and other things that like kind of your classical banks do. But right now, they're very member centric and member focused. And I think
Hmm.
they grow that to the point at which they're a household name. Like the same way that you talk about, JP Morgan Chase or Wells Fargo or Citi. Like I think that they'll have enough users where it will be a household name. Just because they offer something that's differentiated enough and sticky enough that they'll be able to build a clientele and then maintain that clientele. And also as people like millennials like me and Gen Z like you, right, get into banking, like more and more I think people are going to be moving to things that are just cloud based.
It's so much cheaper to do that, and it feels like they actually have your back. Like anytime I get a notification from SoFi, I'm like, well, oh, my APY just went up. Like they're being competitive. They're reminding you that like, hey, we got you like every single time. And I think
Yeah,
that
I agree. Like I just feel there's safety in SoFi. They're a chartered bank, right? And I felt fine even before they were a chartered bank. I didn't feel like my money was at risk because
mm,
they were doing things above board and they actually had partnerships with chartered banks. So the money
mm,
was FDIC insured and stuff, right? Um, but they're really transparent in everything that they do. And like you just said, I totally agree with you. I just feel like they've got my back as a member, right? Like the marketing comes off as a little bit kind of it's like in some ways
break
it's just
up with banking.
slightly break up with
It's
banking. It's just slightly like it's a little
they
what's
focus
the
on
right
real
word?
young.
Yeah, like it's kind of a little
Uh,
immature in some ways. Like
yeah,
that's not quite the right word.
yeah.
Um, but
Where Bank
this,
of America is doing like advertisements of like art pieces, and Goldman Sachs is doing like a museum coin, or yeah, Goldman Sachs has a commercial where like they're in a museum and they're all looking at Roman coins and they're like save coins with Goldman. It just looks super like sophisticated.
right.
Where SoFi is like the exact opposite. Like
Yeah,
break up with bad banking, they're treating you horrible.
yeah, exactly. And so, but so I think that they're differentiated enough and sticky enough that they'll be able to get the clientele they're looking for.
Mm-hmm.
And then I think 5 to 10 years, like that's where you want to see the ramp from the technology segment, um, which is going to be that's going to be the part that if SoFi takes off, like I said, that's going to be the basis for that, right? It could,
Mm-hmm.
you know, if it grew to the size of Wells Fargo as a bank, right? Wells Fargo is something like $150 billion market cap, right? So that
Wow.
already would be like a 30x from where SoFi is, right? Which is ridiculous to think about because Wells Fargo, nothing against them personally, but I had a terrible banking experience with them, right? So it seems like SoFi should be able to get to the market share that they hold,
Mm.
just from my like a very high level, not like an analysis portion. But if they end up being the back end for, all the neobanks and all the fintechs that come on, and they end up being the AWS of fintech, and they even get some of these legacy players to be on their core technology and to use, their ledger systems and everything else, then they can become something that's so much more than just a bank. And that's where
Mm.
the real growth potential of the stock comes out. And that's like honestly to be determined over the next 3, 4, 5 years. We'll have a really good idea what the trajectory is there.
Yeah, I think you're right about that. Uh, Competition, I don't see any competition with SoFi. I think SoFi is not competing in a market, but they're trying to change a market, like what Amazon did. Uh, you look at eBay and Amazon; they looked very similar 20 years ago. But
Right.
what they were focused on two different things. What do you think in competition?
So I think that there's a ton of neobanks, right? And there's some that
Mm,
have significantly more members than SoFi does. Like Chime has way more members than SoFi does right now. I don't know of a lot of competition in their target market. So they're focused on, these high earners and high credit scores and high quality people who are want to, get their money right, as they say. But basically, what that means is people who want to be financially savvy, they want to feed them those tools, right? And I don't know of any other online banks in that particular niche. If you talk about neobanks in general, there are a ton of different ones. There's Acorns and there's Dave
mm,
and there's Moneyline and there's Chime and like,
they're all niche
Robinhood's,
focused.
and they're
Yeah,
all they're all very niche focused. In SoFi's specific niche, I don't think there's anybody else who can outcompete them right now. Like I haven't seen a product that
yeah.
competes in that same niche, and that the other thing is that they are more diversified than any of those offerings, right? If you want all of the offerings that SoFi has, then you have to go to a traditional bank, right? Like at Chase, you can have an investment account and you can have, all of these different things, but it's going to be a traditional banking experience along with
Mm,
all of those. If you want a digital only bank and you want to have something that has all of the offerings, I don't think there is a competition as far as SoFi goes. And as they like to say, it's winner takes most, right? Like it's not that SoFi is going to become the only bank and they're going to be a monolith and they're going to be a monopoly and everybody in the entire United States is going to have a SoFi account. That's not it, right? But the
mm,
point is that if they get to the point at which they're at 40 million members and all of those members are really
wow.
high quality people who then continue to use SoFi for their mortgage and if they need a personal loan and, bank with them, and if they start a new business, now they use them as their small
Wow.
business account. And like you've got all these Gen Z entrepreneurs and millennials who are then aging and coming into their full earning potential. you know at that point, if you they could take most of that group. And I like I don't know of any competitor who has the offerings that they do right now, and one might come up, right? But for now, I don't. In their target market, I think that SoFi is far and away the best option if you want a digital only solution.
Yeah, same here. They're so much more vertically integrated from any of the competition, where they're more serious about that side of their business than any other.
Yeah, and on that point about the vertical integration, they're also the low cost provider, so that also helps them, right? One of the reasons they can give such a high APY is because their backend, they own it,
Mm,
right?
mm,
So if I'm, Chime or Robinhood, and I want to build my client base, one of my costs is every single time they go and they swipe their debit card, I have to pay Galileo a fee, right? But if I'm SoFi, then I every time they swipe their debit card, I don't have to pay a fee because I own the underlying technology. And
mm,
so, like part of the vertical integration means that they can be the lowest cost provider. They have better margins on their checking account than anybody else because they own the back end, right? And so that allows them to then they can offer a higher APY. And if they offer the same APY, they're making more money on that same APY. And so that's a differentiator that allows them flexibility and allows them to increase their margins, right? So it on both ends it helps them.
well said. Last words. What do you think about the current macro environment? Do you think that you have a crystal ball into where the stock price is going to be in 2 years? Because I certainly don't.
No. Um, the short answer is no. So I'm dollar cost averaging, right? Like so every
Same
week
here.
I put a little I have a month like a fund from which like I raised a little bit of cash in the whatever the last like ridiculous bull run that didn't make any sense because the Fed was still raising rates like crazy. I think
Mm,
August or September, right? Like I looked at my portfolio and I said these are the names that aren't doing as well, right? Like these are the ones that are not performing in this environment, and I cut a lot of like I took losses on those positions that I had, and I raised cash. Um, and then when the market went back down, like since then, I've just been dollar cost averaging. And I plan on continuing that strategy for as long as it takes. So my average is much higher than it is. So I started really accumulating in like the summer of last year, SoFi, right? So my
mm.
average is probably in the mid to low teens. Um,
Okay.
and so, but I'm not worried about it, right? There's some of my investments that I am worried about. SoFi is not one of those. Like in
Yeah.
the long term, they're operating so well and executing so well that I'm just dollar cost averaging, and if it stays at this level for a year, I'm still not worried as long as the trajectory of the company is in the right direction, right? Which it is. Like they're
Mm.
growing revenues like crazy. Their profitability is increasing. They're taking all the right steps. Like when you look at the execution, when you look at the app, when you look at the, that they're coming out with new products, when you look at the integration of Galileo and Text and Assist and the new offerings they're offering there, that are in the offing there, like they're doing the right things. And as long as those fundamentals continue to increase, I will continue to just build my position slowly. Um, like I would be surprised if it was at this level for 2 years. Like if they have this
Great
growth trajectory,
opportunity.
like that doesn't make any sense, right? Like,
Yeah.
but um, but I don't have a crystal ball at all, right? Like
Yeah.
people say don't fight the Fed and whatnot, and I'm not going to fight the Fed. But what I'm going to do is I'm going to invest in companies that, despite a harsh macro environment, are growing like crazy, but their stock
Mm.
price is coming down. Like
Yeah.
those are the type of companies that I want to own because they're really resilient in the worst possible environment, which means eventually when multiples
Yeah.
start to increase again and when, the next bull market starts, which whenever it is, 2023, 2024, 2025, I will have built a position in that and be able to like take advantage of the next cycle, right? If you look back in time and you look back at the dot-com bust and you look back at the 2008, right? Like even if we're only halfway through the drop right now, like if you look back and you said, I would have if I invested 50% of that drop to today, like you would have had ridiculous amounts of return. So even if we're not at a bottom, which we might not be,
Yeah.
right? Stocks could go down another 20, 30%. If we have a deep, long recession, they could people are talking about like 2,800 on the S&P 500 and stuff like that
Wow.
as possible targets. And that is possible, right? Those are within the realm of possibility. But when you look out 5 and 10 years, like you still would have been kicking yourself for not buying at those prices,
Yeah.
right? And so that's in the long term, if you buy good companies whose fundamentals are improving, eventually that investment is going to pay off. Because like the classic Benjamin Graham quote, right? In the short term, the market is a voting machine, but in the long term, it's a weighing machine.
I
And I'm
love that
really
quote.
confident that
Yeah.
SoFi is going to be weighed, like they are adding large amounts of fat right now. And when we weigh
Mm.
them, it's going to come out and we're going to be just fine.
For sure. Once they become a household name, everything is going to change. That's what's going to set everything off, in my opinion. Chris, thank you for doing
Yeah,
this. I
sorry.
appreciate it.
It was awesome talking to you. It's been a good conversation.
No, I honestly gained a lot of insight from this. It makes me want to just dollar cost average more. But this is not investment advice, of course.
Right, not investment advice. I am not a financial advisor.
No crystal balls here.
No
Um,
crystal ball.
okay, well, I'll talk to you later. I appreciate you coming on, and shortly after this, I'm going to have all your stuff in the actual video, so everybody
Okay,
will be able to see that and follow you and read all your new articles that you write while at home.
while at home.